So quiz 2 is coming up, so I thought I'd go through some of the material that this quiz will cover. And it's again not difficult stuff, but there are lots of little nooks and crannies where you can get lost. So I'm going to try to focus on as much as I can on the places where you can get lost in this particular quiz. Let's review the material that we're going to cover. First, we're going to cover the last two ingredients in DCF valuation. The first, of course, is expected growth. We got all the way through discount rates in the last one. So in this one, I want to talk about, we got through cash flows. I want to talk about expected growth. We talked about historical growth, analyst estimates, fundamental, but the emphasis is going to be primarily on fundamental growth, partly because historical and analyst growth, what can I really ask you? I have to give you the number. The other big number in discounted cash flow valuation I want to talk about and emphasize some basic rules is terminal value. Almost every problem every quiz you will see in the past, there's at least one problem where I'm going to ask you to compute the terminal value just to make sure that you follow all those consistency rules. We spent a fair amount of time talking about what I call the loose ends of discounted cash flow valuation. What to do about cash? When should you discount cash? When should you attach a premium? What to do about cross holdings, minority and majority holdings? And I mentioned when we were going through it that this is the place where a lot of people trip up. It's easy to get mixed up on what to add, what to subtract, what to ignore. So I'll go through that process. If there are any other assets that have not been counted yet, the keyword is have not been counted yet. No double counting allowed. You have to bring them in. And once you've got the value of the firm, you've got to subtract out debt and any other potential liabilities. I'm not trying to be mysterious here, but if you have a lawsuit hanging over your head, this is your last chance to deal with it. And so we'll talk about how to adjust for those. And finally, we spent some time talking about employee options and other management compensation and how they might affect your share of stock and what the value of that share is. Then we went into a bunch of DCF valuations where the mechanics were in the background, but we still had to estimate cash flows for each of these companies. So how we estimated them might vary across companies. What to do about discount rates that change, because as a general rule, cost of equities and cost of capital can change over time. And finally, checking the inputs that you're using in valuation for consistency. So let me get the process started by first talking about fundamental growth. The key thing to remember about fundamental growth is you're estimating growth by looking at a product of how much you reinvest and how well you reinvest. So if you're looking at growth in earnings per share, for instance, you measure how much you reinvest with the retention ratio. Basically, how much of your earnings you did not pay out in dividends. And you measure how well you reinvest with your return equity. This growth measure you probably will use only for banks or using the dividend discount model, but it's a good starting point. How much do you reinvest? How well do you reinvest? When you're talking about net income from non-cash assets, there's a mild difference. Instead of using the retention ratio and assuming that everything you don't pay out in dividends is reinvested back in the operating assets of the company, you actually explicitly estimate how much you reinvest by looking at net capex and change in working capital. And because you're concerned about equity, you subtract out the amount of that reinvestment that came from debt and divide by net income. So that number, unlike the payout, unlike the retention ratio, which cannot be below zero and cannot exceed 100%, equity reinvestment rates can be negative numbers for companies that are shrinking, and they can be greater than 100% for companies that are reinvesting huge amounts. And when you think about return equity, if you're focused on non-cash assets, you're focusing on non-cash return equity. You're saying, what the heck is that? Just remember to subtract out the interest income from cash from your total net income. So you look at the net income from non-cash assets. And when in your denominator, instead of dividing by book value of equity, which is what you do with traditional return equity, you net cash out. So it can make a big difference for companies like Apple, which have a lot of cash in their balance sheet. With operating income, your measures of reinvestment and return also change subtly. Your reinvestment rate now will be your net capex and change in working capital. So don't net out debt because you're looking at the total reinvestment. But now you're going to look at it as a percentage of after-tax operating income, not net income. And when you think about returns, you're looking at return on capital or return on invested capital. And that, again, you're taking the after-tax operating income and dividing not by the book value of equity, but by the book value of equity plus debt minus cash. That's called invested capital. So one of the first things to check when you have a problem, and I'm asking you to compute the fundamental growth rate, is what measure of earnings and cash flows are you looking at? Are you looking at a dividend discount model, in which case you're going to go with the earnings per share approach? Am I asking you to compute free cash flow at equity, which might be the net income from non-cash assets, or are you looking at free cash flows of the firm? Now, the other big piece of discounted cash flow valuation was terminal value. And there were four very, very simple rules that kept this number from running away from you. First, as I said, obey the cap. The growth rate using in terminal value should not exceed the risk-free rate. Now, this is often not going to be an issue in past quizzes because I give you the growth rate in most of these problems. But even if I did not give you the growth rate, don't violate that rule. That's a one rule that you cannot break and get away with. Second, if you're looking at a stable growth firm 5-10 years out, give it the cost of capital of a stable growth firm. Again, in most quizzes, I tell you what that cost of capital is, but even if I don't tell you that number, that's a judgment call you can make, and I will never take points off if you move the cost of capital towards a mature cost of capital for a risky company. Third, think about the return on capital in perpetuity. Not the return on capital today, but what will the return on capital be after you get to year 5 or 10? Because that return on capital is what's going to allow you to compute what you need to reinvest to compute your terminal value. And that's key. You cannot just take your reinvestment rate from year 2 or 3 and just extrapolate it into your terminal year. So let's take an example. This is a problem from the fall of 2011, but you can pretty much take any quiz and you will find a problem just like this one. This is a family-run, publicly traded company that expects to generate $60 million in after-tax operating income next year on capital invested of $1 billion. File that away. So I've told you how much after-tax operating income they have and how much capital invested. When we talk about capital invested, again, we're not talking about market value. We're talking about the book value of the capital invested. The firm has a cost of capital of 10% and expects to maintain its current return on capital while growing 2% a year in perpetuity. What is the value of the operating assets? I've given you the growth. I've given you the cost of capital. I've given you the after-tax operating income. The only thing I haven't given you is how much they will need to reinvest next year, but I've given you the clues on how to compute that. I said it expects to maintain its current return on capital. So here's the first thing I did. I computed the current return on capital by dividing the $60 million in after-tax operating income by the book value of capital invested. I gave that to you in the problem, but I could have been a little more indirect. I could have given you the book value of equity and debt and cash and expected you to compute it. Or I could have given you the return on capital directly. But there is no way you can compute a terminal value unless I tell you something about the return on capital in perpetuity. In this case, the return on capital is 6%. The cost of capital is 10%. The company is generating less than its cost of capital. To get a growth rate of 2% with a return on capital of 6%, I'll need to reinvest 2 over 6, which is a 1/3 of my after-tax operating income every year in perpetuity. I have all the pieces of the puzzle. I have the after-tax operating income of $60 million. I net out the 33% that's reinvested, so I get to have a cash flow of $40 million. Divided by the cost of capital minus the growth rate gives you $500 million. Let's think about the variations you can have here. I could have, instead of giving you the after-tax operating income and capital invested, I could have made you compute that capital invested, not just by giving you the book value of equity, debt, and cash in your terminal year, but by giving you the invested capital at the start and told you how much I'm going to be reinvesting every year for the next 5 years. You say, how is that going to help me? Remember what we said in class, when you reinvest something back into the business, that's an increase in your capital invested. So if you take your existing capital invested and you take the reinvestment every year for the next 3, 4, 5 years, what you end up with will be the capital invested in the 5th year. I think there's one quiz, I don't remember which one it was, maybe the 2008 quiz, which is a high growth firm, where I gave you the entire cash flow table. After-tax operating income, capex, depreciation, free cash flow to the firm. I gave you capital invested at the start of the process, and you had to estimate the return on capital in your terminal year, because I said that your return on capital in perpetuity would be whatever the return on capital was in year 5. So you had to actually take capital invested and build it up to it. But whatever you're doing, keep your eyes on the price. You need to get the return on capital to compute a reinvestment rate, and without the reinvestment rate, you can't get a terminal value. So that's a terminal value and the growth components. Let's look at the loose ends. Key point to remember is cash by itself is a neutral asset. It earns a low rate of return, but that rate of return is a fair rate of return. However, as we noted in class, the market can sometimes discount cash, not because cash earns a low rate of return, but because they're worried you might waste the cash as a company. Sometimes markets may attach a premium to the cash because they think that you can use the cash in some, not just in some productive way, but that use it as a strategic weapon, where if markets shut down, you're able to use the cash to buy assets at a discount. So the key thing whenever you have cash in a problem is to see if there are any other clues that I've given about what the market might do with the cash. So here's an example. This is part B of a problem, fall of 2011. it's a problem where I have a traditional discounted cash flow valuation in Part A, but then I said this company has 100 million. So this is actually the extension of the previous problem. It has 100 million in cash and marketable securities. But here's where things get complicated. There's a 60% chance that management will take this cash and invest it in assets that generate the return. Remember, this is an extension of the previous problem. So let me go back to the problem. This is the company that's earning a 6% return on capital when it should be earning a 10% cost of capital, right? There's a 60% chance, I'm saying, that this company will take the 100 million in cash and do what it's done with the rest of its capital. Invested in projects that earn 6% when the cost of capital is 10%. So that's what the similar risk profile says. There's a 40% chance that they will leave the cash as is, in which case it'll continue to earn what it's earning now, which is a low rate of return, 1%, right? Which is in commercial paper and T-bills. How much value would you attach to the cash? Now take a look at the problem. When the cash is left where it is, it's neutral, right? It's earning a low rate of return but a fair rate of return. It's at 60% of the time when the management invests the cash somewhere else that you start to get nervous. Because it's not that they're reinvesting, it's that they're reinvesting badly. So here's how I solved the problem. I took the 40% chance that the cash would stay where it is and said, well, the cash is then worth the $100 that I've estimated right now. So that's 40% of the time the cash is going to be worth $100. The remaining 60% of the time, that cash is going to get invested and earn only 6%. So 100% times 6 is 6 million. It should actually be earning 10%, right? That's the cost of capital. If you earn 6 million a year and your cost of capital is 10%, the value of the cash is 60 million. In other words, the 100 million in cash became worth only 60 million because the company was investing in bad projects. Your expected value of cash then is 40% times 100 million plus 60% times 60, which is 76 million. There are lots of other ways you can arrive at the same answer, but basically what I'm factoring in is when you invest cash in bad projects, that discounts the value of the cash. So keep that in mind when you look at any question relating to cash, is I have to tell you what the company is going to do with the cash. Here's the second part, and this is a messy part. Dealing with cross holdings is messy because you first have to decide how these cross holdings are being classified. Are they minority holdings where you own 5, 6, 10% of a company? Are they majority holdings where you might own 55, 60% of a company? With minority holdings in general, the income from these holdings is not part of your operating income. So if you do a discounted cash flow valuation starting with operating income, which is what you do with free cash flow of the firm, you haven't valued those minority holdings yet. You will generally have to add the value of these minority holdings, and you have to do this explicitly, to your discounted cash flow value. If you have majority holdings, the analysis depends on what financial statements you're looking at. If you're looking at the consolidated financials, remember that the company counts 100% of the subsidiary as part of the consolidated financials. If you do your DCF valuation, then you valued 100% of the subsidiary when you might own only 60%. So with consolidated financials, you'll have to subtract out the portion of the company that doesn't belong to you, the subsidiary, the 40%, the 30%. Well, minority interest is the accountant's estimate of this, but if I give you information for you to convert into market value, you want to get the market value of the 40% that doesn't belong to you and subtract it out. That's with consolidated financials. If I give you just the parent financials, remember they don't include the subsidiary. Then you have to value the subsidiary separately, take 60% of that subsidiary and add it on to your DCF valuation. So in any problem with cross holdings, check what I say about the financials. Am I giving you the parent financials or the consolidated? Because how you approach the analysis, especially with majority holdings, can be very different depending on what I give you. So here's an example from spring of 2007. You've been asked to analyze Smithtown Works, a company with one majority holding in Kroger Appliances and one minority holding in Haverford Steel. I've made your life a little simpler by giving you the same growth rate, return on capital, and cost of capital for all three companies. That doesn't have to be. If you had more time, I'd give you different growth rates, different returns on capital, different cost of capital for each company. But I just wanted to make life a little simpler here. I give you information about Smithtown Works. It has 500 million shares outstanding, trading at $30 a share. So I've given you the market value of the equity. I've given you the consolidated balance sheet, and I've underlined it to emphasize it's a consolidated financial where the debt outstanding, cash balance, and minority interest are all reported. The consolidated after-tax operating income reported by the company is $1.5 billion. Remember, It's consolidated. Smithdown owns 60% of Kroger, but because everything is consolidated, 100% of Kroger's stuff is going to be both in the balance sheet items and in the after-tax operating income. Kroger Appliances is not publicly traded. You can't do a valuation, so I haven't given you enough information, but I tell you that appliance companies typically trade at 3 times book value. I also tell you that Haverford Steel reported after-tax operating income of $800 million in the most recent year. Evaluate whether the stock in Smithdown Works is fairly priced. Okay, so I've given you the information, and your job is to tell me whether the equity in Smithdown Works is correctly priced at $30 per share. Let's work through it a step at a time. The reinvestment rate for all three firms here is the same because the growth rate and the return on capital are the same. If they were different for the firms, the reinvestment rates would have been different. It would have made the problem a little messier, but the process would stay the same. So all three companies are reinvesting 20% of their after-tax operating income. The first thing I do is I use the consolidated Smithdown financials. That's all I have. $1,500 million is a consolidated statement. I take out the reinvestment. That's a 1 minus 0.2. I grow it out next year. And that's actually a little question you might have. Why do you have 1 plus G in some of the problems and why don't you have it in others? Here's the secret to answering that question. Check out the problem. If, as in this problem, I tell you that the most recent year's numbers are $1.5 billion, you have to grow it out next year. In some problems, I give you next year's operating income. If I give you next year's operating income, you don't have to put the 1 plus G in there. So just check the problem to see if you have the existing year, in which case you need the 1 plus G, or next year's, in which case you don't. In the denominator for the consolidated company, I use the 0.8, which is the cost of capital for every firm in here, minus 0.02, which is a growth rate for every firm. I get $20.4 billion. You know what I've just valued that? That's a combined value of Smithdown and Kroger because I've used the consolidated financials to do the valuation. I do the valuation of Haverford Steel. This is a minority holding, so that's not in that consolidated statement because income from minority holding shows up below the operating income line. I take the operating income, take out the same reinvestment rate, same growth rate, cost of capital. I get a value for Haverford Steel of $10.88 billion. I've got everything I need. I take the combined value of Smithdown and Kroger, $20.4 billion. I add the cash of the consolidated company. I subtract out the debt of the consolidated company. But here's the final piece that I have to subtract out. I have to subtract out the minority interest. And the reason I have to subtract it out is when I value Smithdown and Kroger, I've essentially got the combined value of equity of the two companies with 100% of Kroger's equity, but I own only 60%. So here's how I subtract out. I take that minority interest of $1 billion, which is the accountant's estimate of what doesn't belong to me, and I multiply by 3. So the key here is because I'm working with the consolidated statements, I have to take out the portion of Kroger that doesn't belong to me. That's what I'm doing by netting out the 3,000. I get a value of equity of $14,488 million. To that, I add the Haverford Steel, the 10% is in there because I have to add that because that wasn't counted. That's what I compare to the $15 billion, and that tells me the stock is overvalued. Let's ask a few what-if questions. What might have been different in this problem? What if I'd given you Smithdown's parent financials? You know what you would have done then? You'd have valued Smithdown as a parent company that would have given you just the value of Smithdown. You'd have valued I'd have had to give you information on Kroger then. You'd have to value Kroger as a standalone company. You'd have to value Haverford as a standalone company. And here's how you'd have got to the final value. You'd have taken the entire value of Smithdown. Remember, it's only the parent company then. You'd have added 60% of the value of equity in Kroger plus 10% of the value in Haverford Steel. So essentially here what you have is a consolidated value of equity. And what allows you to do this here actually is the fact that I've given you the information on a consolidated basis. So with the cross-holding problems, check out the problem before you start working because it makes a big difference what information you're giving and what you're trying to get to. Keep your eyes on the price. The third loose end was other assets, and as I said, make sure you don't double count. If you have an asset that contributes to the cash flows, and most assets do, whether it's a headquarters building, whether it's real estate on which you built your plant and equipment, whether it's refineries as an oil company, whether it's people, even patents, goodwill, all that good stuff, it's already showing up in your cash flows. You can't do a discounted cash flow valuation and add the value brand name on top. That's double counting. So this is more the exception than the rule. You have to find a truly unutilized or vacant asset, a piece of land that you don't use, that you own as a company. Remember the Playboy example. the Playboy Mansion. That's the kind of asset you're looking for with other assets. So don't get distracted by other stuff that's on the balance sheet and don't double count. Final loose end, we talked about employee options, and I went through 3 ways from the worst way to the best way. The worst way, of course, is the fully diluted approach, and here's what you do. You divide the DCF value of equity that you get by the total number of shares outstanding, including the options. So the information you need is just on the number of options, and the bottom line is you will undervalue the shares because effectively you're not even counting the exercise proceeds from the option. If you have the exercise price of the options, you can at least refine your estimate by adding the exercise proceeds to the numerator and dividing by the total number of shares. That's the treasury stock approach. I think it's still a bad way because you're ignoring the time premium on the options. In this case, you're going to overvalue the options. Here's the Goldilocks solution. If you have information to value the options, that's the key if, you preferably you want to value the options, subtract them from your DCF value of equity, then divide by the actual number of shares. So ignore the number of options. The value per share then will reflect reality. You're saying on a quiz, which one do I do? If you have the information to do it with the option value approach, always use the option value approach. If you don't, work with what you have. So here's an example. This is from problem 2 of spring 2008. In this problem, I gave you the free cash flow, equity, and cost of equity to come up with the DCF value of equity. And then to get to the value per share, I told you the company has 10 million shares outstanding. It's granted 2 million options to its management, and I give you the exercise price of the option. Read the problem. It's the exercise price. I haven't given you the value of the option. I haven't given you any of the inputs you need to value the option. I also tell you in addition that the company has to issue 8 million more shares over the next 2 years because they have negative free cash flows to equity. Do with it what you must, but I'm very explicit here. Using the and I probably don't even have to state that you have to use the treasury stock approach because what else can you do? You don't have the information to value the options, estimate the value of equity per share. So let me take you through the process. In the earlier part of the problem, part A of the problem, I gave you the free cash flow at equity, and I gave you enough information to estimate the terminal value. But because your discount rate is changing, and I'll come back and talk a little bit more about this, I have to compute what's called a compounded cost of equity. See, what the heck is that? In this case, my cost of equity was 20% in year 1, but it dropped off in year 2, so I have to compute 1.20, which is the 1 plus the cost of equity in year 1, and I think it was 16% in year 2. It'd be 1.20 times 1.16, and that's going to be my cost of equity in year 2, and then it'll be 1.20 times 1.16 times whatever the cost of equity, 1 plus the cost of equity in year 3. So I'll come back and talk about why I do this, but that's a compounded cost of equity. And you're going to see that line item anytime I have year-specific discount rates. I take the present value. I get a value of equity today, 34.95. Okay? I add the exercise proceeds because I have to use the treasury stock approach. I don't have the information. So it's not that I don't want to value the options. I don't have the information to do it in this problem. So I add the exercise proceeds, which is the exercise price times number of options, and I divide by 10 plus 2, which is the total number of shares that will be outstanding with the options exercised. I get a value per share of 325. Now you might say, what happened to that 8 million shares you will have to issue in the next 2 years? See those cash flows in the first 2 years, the big negative cash flows? They're lowering my present value by about $15 million, right? I've actually lowered my value to reflect those negative cash flows. The number of shares I'm going to be issuing in the next 2 years is to cover those negative cash flows. If I increase the number of shares today by 8 million, I'll be double counting. Why? Because I've lowered the present value because I have negative cash flows, and I'll be also upping the number of shares. So if you're doing a discounted cash flow valuation, don't worry about future stock issues. They're irrelevant. If you have negative cash flows, your valuation will already take care of those future stock issues. We're almost at the end. Let's complete the process. So the mechanics of DCF, 2 big issues. One is cash flows, the other is discounting. If you have cash flows, first check to see whether you're estimating cash flow to the firm, which is pre-debt. So you'll be working with after-tax operating income, and there'll be no debt payments, or to equity. Make sure your cash flows are always after taxes, always after reinvestment needs. So in every problem, I have to give you the information to estimate the reinvestment needs, either explicitly as capex, depreciation, working capital, or implicitly by giving you a return on capital and growth. So let me explain. So if I tell you your growth rate is 10% and your return on capital is 20%, you will have to reinvest 50% of your after-tax operating income every year if that return on capital stays stable. Or if you have a company with a changing margin, and you saw this with young growth companies, then you might have revenues, changing margins, and have to give you a sales to capital ratio to close the process to estimate your reinvestment. The other issue with DCF Mechanics is discounting. Is the couple of rules to make sure. First is match up the risk of the cash flow to the discount rate. Don't get too caught up in getting the cost of equity and capital for the firm. Because if I give you a guaranteed cash flow to a company, remember, if it's a guaranteed cash flow, it's riskless, even if it's a risky company. You should use your risk-free rate as your discount rate to check for clues that I might give you on the specific cash flows risk. Make sure your cash flows and discount rates are matched up in the same currency. Make sure that if you have cash flow to equity, you discount at the cost of equity, cash flow to capital, cost to capital. And if your cost of equity or capital changes over time, make sure you discount back at that cumulated number. So let me very quickly go through at least the mechanics of this process. This is from fall of 2010, the problem where I gave you the revenues of, so in fact, I've given you all the information in this problem. And this is actually the problem where your cost of capital goes from 14% to 12% to 10% over time. So you have changing cost of capital. And this is actually the problem where I asked you to compute the return on capital in year 3, where you have to take the capital invested today and to it add the reinvestment each year. So if your reinvestment is negative, your capital invested will decrease. If your reinvestment is positive, your capital invested will go up. But the last part of the problem asks you to do a valuation. So here's the last piece, the last part of the problem. You got the cash flows, you got the cost of capital. When I talk about the accumulated cost of capital, here's what I mean. The year 1 cash flow is no problem. I discount it back at 1.1 at 14%. 1.14 is the cost of capital. Year 2, my cost of capital is 12%, right? I cannot discount back year 2's cash flows by taking 1.12 squared, which is what we usually do when we do discounting. I have to take 1 plus the first year's discount rate times 1 plus the second year's discount rate, giving you 1.2768. Now you can already see for year 3 then, you'll have 1.14 times 1.12 times 1.10. That is your discount factor. You divide your cash flow by that discount factor, you're going to get a present value. Add those present values up, you got a value for the operating assets of this company. So in summary, make sure you got the mechanics nailed down on getting cash flows and discount rates. Take a look at those loose ends, cash, cross holdings, and options in particular. And with options, remember, work with the information you have. If you have enough information to get the value of the options, always do it the right way. If not, use the treasury stock approach. That's about it. I hope to see you in class on Monday. Actually, I will see you in class on Monday at 1:30. Take care.